Hello investors! Dividend investing may be one of the most reliable and profitable types of investing. In this video, we'll go over 10 tips that will hopefully improve your dividend investing strategy. Avoid value traps. Value traps are when a dividend yield appears to be great and a company appears to be undervalued due to a decline in price. But, in reality, the price decline has been caused by valid factors, giving the stock the appearance of being a dubious purchase. A corporation paying out far more than its competitors is the first indication of a value trap. Other indications of value traps are declining cash flows with steady yields and excessively high payout ratios. Avoid certain industries. Dividends are not created equally. Because of the sector in which a company works, equities can have high present dividend yields that are either unsustainable or in danger of disappearing. Individual investors should steer clear of commodities and cyclicals. A cyclical business is one that is impacted by the economic cycle. Buying stock in an industry with a history of cyclicality is riskier than buying one in an industry without one, since the business cycle is very hard to anticipate. Corporations that base their operations on commodity prices are known as commodity companies. Commodity-driven firms are therefore very unpredictable. So, as investors, you shouldn't take any recent dividend distributions at face value. Choose companies with consistent dividend increases. Increases in dividends for the stocks in your portfolio are crucial for compounding returns. An indication of a thriving company is consistent dividend increases. A company's performance can be misrepresented in the books and through deceptive reporting strategies, but a dividend payment in actual hard cash cannot be fabricated. A corporation that consistently increases its dividend often has sound management and is stable. Even a little increase of a few cents annually might have a big impact over time. Don't make dividends your only priority. Dividends are one of the most crucial aspects of investing, but they are by no means the only standard to follow. Every asset has a variety of basic components that determine whether it is the best investment for you, many of which are unrelated to the dividend yield. Among the important factors that investors should focus on are things like price movement, earnings growth, and profit. While an enticing yield will undoubtedly catch the eye, never base an investment just on yield. Always take a closer look at a possible asset and make sure you comprehend how that company functions and its position going forward in order to guarantee that you are making sensible investments. A strong dividend may not necessarily translate into a successful firm, but a strong dividend frequently precedes a strong company. Understand how foreign dividends work. Although the US market may be the biggest in the world, it only accounts for 50% of the total investment area. Therefore, there are many options to invest outside of the country. There are a few aspects that investors should consider before allocating funds to international dividend equities. The first item to consider is taxes. Others don't tax dividend income at all, while some countries withhold taxes that are far higher than the usual US rate. The overwhelming majority of dividend-paying equities in the United States follow a set timetable and make an effort to maintain payout consistency. This luxury is not always available on the overseas market. Certain equities have no predetermined payout schedule or size, which makes them impossible to rely on for income needs. Investors should also be aware of regulatory differences, particularly when it comes to accounting and financial reporting. Although the US has very strict requirements for for disclosing important financial information to shareholders, it is not necessarily the case outside of its boundaries. This can make getting a thorough understanding of some stocks exceedingly challenging and time-consuming. When in doubt, it is more productive to hunt for investments elsewhere. Any investor may use international dividend stocks to boost their investing returns with little research, time, and practice. Pay attention to the payout ratio. One of the most important statistics in the world of dividends is the payout ratio. It is used to determine if a company's preset profits have the capacity to sustain the dividend amount. A ratio of above 100% indicates that a company is spending more money than it is bringing in, which is often a warning sign for long-term dependability. Although there isn't a set sweet spot for payout ratios, anything that approaches or surpasses the 100% level is frequently the reason for concern. In order to compute payout ratios correctly, investors should turn to forward earnings predictions rather than backward-looking calculations that employ unadjusted EPS, which provides numbers that are unnaturally inflated. Don't let high yields fool you. It might be simple to automatically gravitate towards a company when you observe a high yield. The issue with that way of thinking is that a stock with a high yield frequently has large downturns. A security's yield may be high merely because it is underperforming, as seen by the security's falling price and rising yield. If the value of your capital base is consistently declining, a high return won't help much. When presented with a high yield, investors should also consider the payout ratio. You might be better off looking elsewhere if the firm is using an unsustainable payout ratio to recruit investors. There are occasions when a firm may sustain a high dividend yield on a regular basis, but investors should always approach a significant yield with care. Be sure to do your homework to ensure that the payout is consistent, sustainable, and the company itself is on a solid foundation. No tax implications. Over the years, the dividend tax structure has undergone a number of revisions and modifications as politicians work to create the most comprehensive and equal system possible. Most of the time, capital gains taxes will be lower than regular income taxes. If you recall, Warren Buffett once said that he pays less in taxes than his secretary. This is partly because a sizable chunk of his income comes from dividends, which are taxed at a lower rate than if they were earned through salary or other forms of compensation. Reinvest your dividends. Dividend reinvestment is the practice of purchasing additional shares of the same investment with cash dividends received from a firm or fund. Since most brokerage accounts feature automatic dividend reinvestment schemes that automate the acquisition of fresh shares of the same company, ETF, or mutual fund, any investor may employ this approach. Similar to this, a lot of dividend-paying businesses provide investors the chance to take part in a dividend reinvestment scheme. While this is going on, investors can manually reinvest their payments, even if a broker or business doesn't provide an automated dividend reinvestment scheme. Invest for the long term. You must make long-term investments if you want to truly transform your portfolio into a dividend powerhouse. Finding a reliable dividend payer and sticking with it over time is very important. The ability to postpone paying capital gains tax is a tremendous benefit of long-term investing. Investors who own stocks that increase in value have the option to resell such securities for a profit. The capital gain is the difference between the purchase price and the sale price, and tax is due on this income. But because the tax is only due when the asset is sold, owning stocks for a long time permits the deferred capital gains tax to mount. When you take into account all of the moving variables at play, beginning a dividend investing strategy might be a bit frightening at first. Before going on to more complex tactics, It's crucial for novices to take the time to comprehend fundamental principles, including all of those listed in this video. Know that learning about investing is a lifetime process, so arming yourself with knowledge before making an allocation can help you get off to a good start. Please like and subscribe to the channel for more content on investing.